This is the Daily Market Rundown live from the Tradelo trading floor. It's February the 19th. Some highlights from today's show. BOE inflation is causing a headache, the German DAX has now topped, and Japanese yields are a key risk event. Good day traders, and welcome to another Daily Market Rundown. Let's get stuck straight into it. In terms of any sort of key things to watch out for overnight, I think it's very much a case of oil is on the bid this morning. We did see that sort of bottoming process over the course of last week, and we are seeing oil just tick up a little bit now, starting to see it find a little bit more support. Apart from that, there's absolutely nothing going on, but there is a little bit of steepening going on in the bonds, and we're going to talk quite extensively about the bonds today because we know higher yields do pose a risk, particularly given all the issuance that is expected to take place from the likes of the US and some of the other big countries. So let's get stuck straight into it and talk about our first key topic today. It was all about the UK. We had a very hot inflation print. Now that in its own is not necessarily market moving. The rates markets don't really give two hoots because we've got the Bank of England saying, well, look, we'll just look through it. It's short term. We're not too worried about it. It's transitory. They make up all these reasons why they're just going to remain on the dovish side and continue to cut rates. Keep in mind the UK economy is in a recession just like Europe, so they can't really afford to turn hawkish at a time when interest rates are still very, very restrictive. Now that being said, the inflation print did come in quite hot. It was the highest print in 10 months. And what this starts to smell of, and we've been talking about this as a theme for some time now, is that sort of stagflationary environment where we have little to no growth or recessionary type growth followed by an inflation number that is a lot higher than the 2%. Now, that very much ties the hand of any central bank. There's very much nothing a central bank can do in that situation. They can't hike rates. They don't want to hike rates, but at the same time, they can't cut rates. So very much what they do is they just try to keep their mouth shut and hope that inflation does come all the way back to target all by itself. Now, the key takeaway from all of this is that there's nothing really going on in the rates play, but if you take a look at, of course, what the curve has done, it has steepened out. So we can see the gilts have responded to this. Now, why does this matter? Because if we go look back at the start of this year, we had that little bit of a concern in the gilt market. Of course, it was pinned on the Chancellor Reeves. I'm not so sure that was the case. I think it's very much this idea of, well, look, yeah, UK, you're printing in some hot inflation numbers. As investors, we want a little bit of higher yield. We cannot accept this situation, and risk premium ultimately is what drove those yields higher. That's not a new theme. We've seen that in the US, we've seen that in Europe, and we see that across the board now where investors are starting to say, we want higher yields and we don't want to hold your bonds without being justified for the risk. Now, again, I think why that matters is because that steepness come into play today. We have seen that 440 hold in the gilts. It was, of course, a very important level early on last year. We broke above it late last year. We've come back and tested it, and I suspect now path of least resistance is back up towards that 490 over the course of the next couple of sessions. Now, what does that mean for general markets? Well, in general, right now, the markets can very clearly handle 460 yield. They can probably handle 470, 480, 490. Keep in mind, however, the UK, the same with Europe, the US, they all have heavy issuance schedules, and at some point, higher yields will have implications for global markets. Will it be today? Perhaps not, but it is something we pay very close attention to. So path of least resistance, high yields for the UK market. Now, our next topic is again on the bond front, because it's not just the UK that is struggling with high yields. It's now the turn of Japan, and we'll get to that chart in a moment. But we had a BOJ policymaker come out. Takata told us that, look, we are seeing these inflationary pressures continue to rise. We are still of the view that we will need to hike rates. We're not going to tell you when. We'll keep that door open. We'll keep full optionality as we do at the BOJ. But we acknowledge that more rate hikes will be needed as we sort of tame these inflationary pressures. Now, the BOJ is, of course, above its 2% inflation target. They are expected again to hike rates in July this year, but we are seeing those inflationary pressures come in the near term. And of course, we did have a recent very good GDP number. So What number do they hike to? Well, they keep the market guessing. That's the problem with the BOJ. We've had one policymaker, Tamura, come out and tell us, look, we'll get to 1%. We're not going to tell you when. We think we need to get there. Now, keep in mind, they're only at 50 basis points, so we're about 2 rate hikes away from that. Now, what do you want to take away from the BOJ? Well, again, they're going to keep us guessing. We're not going to really get anything from it. But I think what you want to take away from it is very simply that they are running a negative real rate. What's a negative real rate? Well, right now, inflation is running close to 3%. We can see the base rate is at 50 basis points. So in effect, they have a real rate of around 2.5% negative. Okay. When we compare that to the US has rates at 4.5%, and we've got inflation around that 3%, depending on what inflation metric you use. So they're running a positive real rate of around 1.5%. Okay. That divergence of positive 1.5 versus negative 2.5 is why no one wants to own yen. Instead, they want to hold the United States dollar. Now, that's not to say it's the case for some of the other currency pairs, and that's why I think if you're going to trade this situation in Japan, I don't think you trade long yen against the dollar. I think there's going to be far easier players. Think long yen against euro, think long yen against pound. I think that's where you're going to get your best bang for buck in terms of rate differentials. Now, I think one of the key takeaways is perhaps not the news flow, but ultimately what those Japanese 10-year yields are doing. This is, in essence, the yield chart of Japanese yields. And you can see that we were at just stupid levels for a significant period of time. Now, keep in mind, Japan's debt to GDP is around the 260% mark. So they are effectively a very heavily indebted country that pretty much owns their entire bond market. But ultimately, these high yields are going to have longer-term implications, because for the first time in history now there is a cost to borrowing in Japan. Now, it shouldn't necessarily be a problem for, of course, Japanese bondholders. Why? Well, because Japan owns its own bonds. Okay, that's not like they have foreign investors that are going to suddenly start dumping their bonds. But the point is that there's not a lot of love for Japanese bonds here, and so I suspect we continue to see these bond yields march higher, so long as, of course, the BOJ is going to remain with that negative 2.5% real yields. Okay, if they want to stop this march higher in the back end yields, they're going to need to become a little bit more forceful in front end yields. They are going to have to drive back down some of those inflation expectations. For now, does it matter? No, perhaps not. But look, we are up 35 basis points this year. That is not a small move, relatively speaking. Whenever you get this sort of rate of change in yields, you've got to be paying attention. It is a key risk event that at some point it's going to matter. Okay, so that's the key takeaway from you, is how do you trade this? What do you trade? Well, like I said, I think long yen against the likes of euro and pound is where you're going to get some bang for buck. But keep in mind, at some point, these higher yields, whether it's the UK, whether it's the US, whether it's Japan, at some point they will create vol, and vol is ultimately where you can make some good money, of course, as a day trader. Let's now turn our attention to one of our key plays for today. Mr. DAX, Mr. German DAX, seemingly has found out its top. Now, if you go back and look at the DAX over the course of the last 12 months, sort of the start of last year, you can see that pretty much DAX did absolutely bugger all year. It flatlined. No one was interested in touching the DAX. We did have a little bit of a corrective move in August. That was, of course, when we had that carry trade concern out of Japan, as well as, of course, the economic slowdown in the US via the SAM rule triggering in non-farm payrolls. So that's what created a little bit of a correction. If you can look at the DAX over the course of last year, it was pretty much flat until all of a sudden October, November, when we started to see some gains, but again, no one was really interested in trading DAX. Ding, 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 fast forward to December. What happened? Well, all of a sudden, we had the calls for election. Okay, we had the no confidence vote, and all of a sudden now everyone wants to own DAX. Okay, so since then, we've staged a 13-14% rally. I suspect almost everything about this rally has got to do with this idea that the new incoming government is ultimately going to release the fiscal debt brake, allow for reinvestment, allow for a splurge in spending. I suspect that is what's driving the DAX. However, like I said, we have now seemingly topped. If you go look at the 60-minute chart, which we'll do in a minute, you can see that those sellers stepped in a very meaningful way today. And I do suspect now we're going to get a little bit more two-way trade in this market, a little bit more of consolidation, particularly because we now do have that election coming up this weekend. What I did say, and I think this is going to be a key thing to watch out for, I suspect this is going to be a typical buy the rumor, sell the fact type scenario where we'll find out a little bit more next week and the week beyond that about what the coalition's thinking is around the debt break reform. We'll get an idea of what percentage of debt to GDP they're thinking, and I suspect once we get that announced, it will be a case of we'll see some further profit taking in the DAX. Okay, I think very much this event is priced into the DAX, and so I think it's going to be a typical buy the rumor, sell the fact type scenario. Now let's turn our attention and look at that 60-minute DAX chart, because what you can see is that yesterday we staged a very, very decent buy reversal. It was quite strong, the price action. It was quite intentional. For all intents and purposes, you look at a daily chart, that was a very, very strong close in the DAX. They came in this morning, they popped it, and guess what? Those sellers said, no thank you, it's now time to take some profit. So very strong auctioning coming off of that 22,900 area. I suspect we do have a top in place in the DAX now, and we're going to continue to see this drift in lower. We've got a little bit of a consolidation area to test in around 22,500, but again, there's no real support in this market for some way down. If we go back to that daily chart, you can see we do have that gap coming in around that 22,200. I suspect that gets filled out now over the course of the next couple of days. So pay attention. I think DAX is very much a sell-only market. It's not a market you want to be buying yet. It is very overbought, and it is now likely to stage some form of a topping process. Let's now turn our attention and talk about some of the other things to pay attention to today. We spoke about this earlier in the week. It's very much OPEX week this week. So the equities do seem very range bound. S&P seemingly stuck between this 6,100 to 6,150 area. I suspect we stay there until Friday. So it is very much buy the dips. Look for that little bit of downside volatility to fade. And don't be afraid to get stuck into it, because you can see if you look at yesterday, we had quite a decent bid up into the close. So it's not a case of, bulls are not wanting to buy. It's just no one wants to buy the top until OPEX clears. Okay, so I suspect what's going to happen is we'll see a continuation of collecting of positions at decent prices, and then I think on Friday we probably stage that breakout into the record territory zone. Apart from that, there is no real key data out today. Pay attention to those bonds. I think that is ultimately where we're going to see some movement and opportunity. We do see that theme of higher bond yields, not just in the UK, but it's also in Germany, and of course also in the US. So it is a theme of higher yields and of course a little bit of a topping process in the German DAX. That's it for today then. If there are any other questions, do post them in the Discord channel. Otherwise, good luck out there, manage that risk, now go make some money.